Hello everybody and welcome to Netwealth's webinar. Today's webinar is titled Is Up the New Consensus? And it's about portfolio construction in the changing global economy. And we're fortunate enough to have Lukasz de Pourbaix here with us today. Before we get started, we'll just go through some housekeeping. The webinar is being recorded and we'll send the slides to you after the webinar. If you have any questions, you can enter them in the chat, normally on the right-hand side of the screen. And if you like to post to social, please use the hash NetwealthInvest or tweet at NetwealthInvest. And finally, if you'd like CPD points, we'll send you an email after the webinar. And if you complete the questionnaire, you'll be able to receive your CPD points. I'll just introduce Lukasz to you for those people who haven't met him before. Lukasz is responsible for harnessing Lonsec's broad investment research and portfolio construction expertise to deliver effective and efficient portfolio solutions to financial advisors. He is also a chair of Lonsec's Asset Allocation Investment Committee. Prior to taking the CIO role, Lukasz was Lonsec's General Manager of Investment Consulting. He provided portfolio construction and manager selection advice to dealer groups, to fund managers, super funds and private wealth institutions. He is currently on the board of the IMCA and chair of the IMCA Seminar Committee and member of the Nominations and Membership Committees. I'll hand you over to Lukasz.
Great, thank you, and thank you everyone for taking the time out today to listen to me speak about the topic. So is up the new consensus? Certainly if you think about 2016, it was a momentous year on every front. I think all the things that were unexpected, certainly by most people, happened. We saw Brexit, we saw Trump, and despite all of these things, markets have continued to roar ahead. We've had the S&P 500 do 21% for the year. And interestingly, if you compare to about 12 months ago, the rhetoric in the market has also changed. 12 months ago, there was talk of deflation, of economic slowdown, and certainly how quickly things change. At the moment, a lot of the discussion seems to be the prospect of rate rises, maybe the possible risk of inflation, and certainly sentiment has tended to shift over the last sort of 9 months or so, and certainly on the back of the recent election results in the United States. So today what I wanted to cover off is to provide a bit of backdrop of what we're seeing in markets and a bit of a view on what are some of the maybe go forward scenarios. Talk about what we've observed in terms of that dramatic shift in markets, certainly away from from defensives towards cyclicals, and finally, what implications do some of these changes and shifts have for portfolio construction and manager selection? So I'll get straight into it. If we think about since 2008, we've been in a very interesting environment whereby markets have certainly been driven, in our view, by macro factors, and certainly very influenced by central bank policy. So if you think you cast your back to 2008, obviously we had the global financial crisis where we're coming up to the sort of 9-year anniversary of that. At that time, central banks undertook quite aggressive, I guess what we'd call unconventional monetary policy via quantitative easing to stabilise markets. That in turn saw a massive buying of bonds, government bonds and other asset-backed securities. And you can see on this chart that the dark line, it just shows the rapid expansion of, this is the Fed, the US Fed, the balance sheet expansion since that time. And that's really obviously linked to the massive buy-up of bonds by the government. At the same time, the flow and effect of that has been a dramatic fall in bond yields. So bond yields, that red line, that's the US 10-year. You can see we've had bond yields fall quite aggressively over that time. So that has had material implications on markets. As I mentioned before, markets have certainly been more driven by macro factors rather than fundamentals. The fall in bond yields has certainly impacted asset prices. So asset prices have generally appreciated over this time, and certainly asset prices that benefit from low interest rates and low bond yields have benefited. So things like government bonds, things like listed property, infrastructure to a degree, and more broadly in this environment, as bond yields have fallen, investors have been, particularly from an overseas perspective and in more recent years from an Australian perspective, seeking yield. So any high yielding sectors and defensive sectors as well have certainly been the winners in recent times. But we are observing a slight shift at the moment. So this just shows the bond yields for some of the key markets, the US, Germany, and US. So this is the 10-year, and you can see just in recent times we've seen an uptick in those bond yields. Certainly the Trump factor, if you like to call it, has been part of that. But I guess more broadly, we have been seeing a slight improvement in economic indicators probably for the last sort of 9 to 10 months. And we're seeing that uptick in bonds. But if you think about it, what does that look like from a more historical perspective? This is looking back, obviously, from the 1960s. From the 1980s, we've seen, this is again the US 10-year, bond yields fall to record low levels. So, if you're a bond manager, it's been happy days because falling bond yields are positive for bond returns, and it's no sort of coincidence that a lot of the major bond managers in the market, the likes of PIMCO, etc., started business in the 80s. But you can see that uptick that I was talking about, while it is an uptick, we're coming off a very low base. So it'll be interesting to see, I guess, the trajectory of that. But I think for some time, markets have been anticipating a movement up in bond yields, and I think the election of Trump has been a bit of has spurned a bit of the Fed to start looking at raising interest rates. And certainly if you look at the Yellen, so the chair of the US Fed, and the ECB, they've all indicated that they might be looking to first and foremost reduce the quantitative easing programs, but also the possibility of rate rises, which will obviously have implications for interest rate sensitive type assets. Here's just another way of looking at it. This is the US Treasuries, the yield curve from a year ago to sort of early January, and you can see again the shift up in the yield curve. So what it basically means that, look, at some point bonds may start looking attractive again as investors feel they're being rewarded for taking on that duration risk over time, but we're probably not there yet. But all in all, I guess the last several slides indicate that we're possibly moving away from that unconventional monetary policy, that very central bank driven policy and markets, to a more normalised type scenario. It's still early in the piece, but we are seeing some signals that may be happening. So over this period, one of the implications, as I mentioned, that the fall in bond yields and unconventional monetary policy has had, is that it has fueled and propped up certain sectors. So this chart really shows to what extent you've been rewarded for taking on active risk in certain sectors. This is on a global level, and you can see the red bars there on the right-hand side of that chart. Sectors such as healthcare, telcos, utilities, consumer staples. These sectors have certainly been the winners in recent years. So from a fund manager perspective, if you've been, I guess, overweight, or these sectors and your portfolios have been skewed to these sectors, you've certainly outperformed the market and certainly outperformed managers that have been more skewed to those cyclical sectors. And you can see on the far right there, sectors such as materials and energy over that period certainly didn't benefit investors for being skewed to that part of the market. We are, though, seeing a bit of a shift, and certainly the Trump factor had an impact and possibly turned that around a little bit. So if you look at some of the key indicators, here we're just looking at consumer sentiment. Consumer sentiment has certainly picked up in recent times. Now, this can change obviously from quarter to quarter, but it is an important factor to look at. One of the key things, even over that whole period where we had quantitative easing, is that while asset prices were propped up, the consumer sentiment was still fairly poor, but we have seen a pickup in consumer sentiment. We have also seen a pickup in commodity prices, and here I've got, it shows the copper price, and the reason I have this chart on there is that copper is usually sometimes seen as a leading indicator for economic strength. Obviously, it is used extensively in industry and household appliances, and historically that has been there has been a bit of correlation between the price of copper and economic strength. That correlation also that doesn't always hold true, but it's worth noting that we've had a material impact, an uptick in copper prices in recent times. At the same time, when I talked about the sector who's been the winners and losers, in recent times we have seen a bit of a reversal. So here I've got the S&P 500, both the energy and consumer staples indice. The red line is the consumer staples, the green line is the energy index. And you can see that while that sort of defensive play, the consumer staple type stocks have absolutely been clear winners in recent years, in more recent months, we have seen that reverse, and certainly the more pro-cyclical sectors have outperformed the more defensive sectors in recent times. At the same time, those other bond proxy type sectors have retracted, and here I've got the global infrastructure and global property, and you can see that from fairly high prices they've retracted back a fair bit. From our perspective, despite the retracement of some of these sectors, they still look expensive on traditional measures, despite the pullback. But you can see that there's been a clear rotation away from some of these bond proxy and defensives towards the more cyclicals. At the same time, we're increasingly seeing a divergence in performance in fund managers. So if you think about that environment of pro-defense, that defensive trade, the yield trade, it has certainly benefited what we'd call those managers with a quality bias, managers with a bias to growth. So if you can see that with some of the consumer staple stocks, is despite the prices looking expensive, they've continued to rally until recently. So those managers in recent months have underperformed, and the more contrarian type managers, such as, for example, here I've got Allan Gray, have rallied. They were sort of out of the market for a little while, but they've rallied as they were quite early on some of those cyclical exposures based on valuation. So we are noting that you're seeing that increased divergence across the board in active fund managers. And one of the key things we are noting is that if you think about growth has certainly been the winner over the last sort of 5 years or more, we are noting that value style investing is certainly been the winner in more recent times. So the way to read this chart is you can see on the far left hand you've got the value factors, so things like price to book, dividend yield, etc. And you can see that those factors have been generally positive over the last year. So it indicates that the value factors have been the factors that have worked. If you can see that the next sort of segment, the growth factors, the green colour, you can see that those haven't worked as well over the last year. And again, if you go to the far right in terms of sectors, it just sort of verifies that things like materials and energy over the last sort of 12 months or so have outperformed the more defensive style sectors such as healthcare over the last 12 months. And this is a shift from 5 years ago where growth was a stronger signal, and as you can see on the far right, as I've mentioned before, some of those sectors such as healthcare and consumer discretionary have certainly been the clear winners. So what the practical implications for this is really to start thinking about, from your own portfolio perspective, what is the composition of your allocation if you're using managed funds within your portfolios? Are you overexposed to one given factor that possibly has worked very well in recent years, and do you need to diversify? And the same is true if you're investing in directly into the stock market, and certain trades have worked well for a number of years, and as we've seen in recent times, things like resources and the banks have certainly picked up in recent times. Despite all of this sort of shift, the market has continued to rally. As I mentioned in my opening remarks, the S&P 500 has had 20-odd% over the last year. But the thing that we are starting to think about is that valuations certainly aren't cheap. They're not stretched at historical highs, but they're certainly not cheap. So despite the positive indicators that we are seeing both economically and from the consumer, we are conscious that asset classes don't look fairly cheap. And if you think about the S&P 500, and one way to look at valuation is to look at the cyclically adjusted PE ratio. So your PE is, I guess, adjusted for inflation, or the Schiller index is commonly referred to. At the moment, the US market is at about 29. So the long-term average for the Schiller PE index is 16. So we're sort of above that long-term average. The all-time high was 44. That was in the lead up to the tech bubble, and the all-time low was 4, and that was sort of during the depression period. So while we're not at extreme levels, it is important to note that valuations are certainly not cheap, and that's probably fair to say across most markets. We think that assets prices are at sort of fair to expensive territory. So what are some of the things we're thinking about? We have a quarterly investment committee for our asset allocation process where we look at a number of things. We look at valuations, we look at the business cycle, we look at sentiment and momentum. And some of the key things we're thinking about at the moment is that obviously what are the implications of Trump? Certainly we already saw some of those indicators, economic indicators being positive in the lead up to the election, but the Trump effect has added fuel to that. It's been like a boost to already positive figures. So if you think about manufacturing numbers, where such as these numbers, we're at highest levels since 2014. Consumer sentiment is at a 12-year high. Wage growth is at a 7-year high. But on the flip side of that, there are some key things to note. So, Trump has certainly come out with a lot of pro-growth type mandates, cutting corporate tax rates, reducing regulation, all of which may be positive. But on the flip side, he has talked about protectionism, and we've certainly seen a increase in, from our perspective, geopolitical risk. And I think the big one, which is important to note, is execution risk. So one of the things that, from a political perspective, is quite often you'll see politicians come out obviously with an agenda, but in the US, as with most sort of jurisdictions, there is a risk that he doesn't execute on some of these pro-growth strategies, and the market will see that as a negative and retract, because the market has certainly baked in a lot of confidence in that he'll be able to execute on some of these pro-growth policies. So we're thinking about that. But the other big one is obviously that shift away from unconventional monetary policy, and what implications does that have? Now, that's been something that we've been thinking about for many years. It's fair to say that we've been wrong on that. We thought that rates would rise a lot earlier than they did, but we are now probably seeing some real catalysts for that rate rise. We're seeing some positive economic indicators. Certainly the central banks are more willing now to rise. Part of that may be just the fact that a lot of the Fed is dominated by the Democrats, and with Trump being in, I think they're sort of more open to raising rates. But then obviously, what are the implications on asset prices and asset classes, particularly those asset classes that are sensitive to interest rates? And the final thing, as I mentioned, is valuations, and they are looking at fair value to expensive. So in terms of from a more sort of dynamic perspective, I guess to give you some context directionally, we've been closing out our underweight exposure to equities. So we're at slightly weight at the moment. We were more underweight previously. We've been reducing that as some of the economic indicators and earnings numbers are coming through. But at the same time, we remain cautious on valuations. We have been trending down on things like property, really on the back of where we see interest rates going. But overall, we've been fairly cautious. So still have a meaningful exposure to alternatives and still holding a little bit of cash, but really looking to deploy that over time as we see some of these signals improve over time. But really, so what does all this mean for portfolio construction more broadly? I think, as I've mentioned before, we do think that we're moving away from a macro-driven environment to potentially a more fundamentally driven market. That will mean that there are more individual stock opportunities in the market, and that there'll be greater dispersion in fund manager performance as those active managers that have a strong track record and ability to pick individual stocks will certainly, in our opinion, shine in this market environment. Quality and growth has been a clear winner in this environment. So I think the key thing to think about from a portfolio perspective is what is your exposure to those different style factors. Now, I've just on this slide put up some of the key styles in the market: your growth, your value, and your passive exposure. And we've certainly in recent times, as I've said, been in a growth type market. We've had high PE stocks get stronger, people willing to pay up for those defensive stocks, and certainly we've had up markets. But as I've noted before, we have seen value pick up, and value does tend to pick up in that early stage recovery of the market. So from a portfolio perspective, it's thinking about, do you have adequate diversification in terms of some of these factors? And interestingly, I mean, from a research perspective, you also see a lot of product issuance come on the back of strong performance. So on a global equity exposure, if you look at the global equity market and the types of funds that have been coming out in recent years, certainly we've seen more what we'd call quality and growth managers coming out to the market. Now, obviously that's on the back because they've had good performance. We will probably see more value managers coming out of the market on the back of the recent good performance. But that aside, I think you should be looking at your own portfolios and ensuring that you've got adequate diversification so the portfolios can perform across different cycles and not just that one type of macro-driven environment. Some of the things we think about when we're looking at portfolio diversification, so stepping, I guess, one level above style, we generally look to diversify portfolios by strategy. And what I mean by that is just having a very clear understanding of what the role within each manager or investment plays within the portfolio. And we break it down into three core components. We call that beta, and I'll describe that as effectively market exposure. Now, beta can be passive or active, but effectively you're looking at a long-only bias type exposure that gives you that long-term exposure to markets. The second sort of tier we look at is what we call risk control, and that is that part of that type of manager or that type of strategy that can give you some protection in a down market. So if you're looking at managers, these would be typically managers that, for example, can hold cash when asset prices look expensive, or certainly when they feel that there are risks in the market to the downside. So think of that as a bit of your buffer within your portfolio. And the final one I'll point out is what we call alpha, and these are really your high return seeking strategies, and certainly more applicable to your higher growth, longer term type investors, and this may be things such as Aussie small caps, some of the long short type strategies. And then within that, we want to understand what our exposure is to different factor risks. So we want to ensure that what is our exposure to different styles, what is our exposure to different sectors, stock risk, etc. And the reason for that is not to sort of second guess or skew our portfolios, but really to ensure that we're not overexposed to any single factor. And then if we are, we've got a good reason for being exposed, because it's those inherent biases that you may not have clarity on within your portfolios that can certainly have an adverse impact on portfolios. And timing of styles is very difficult. So we would sort of suggest that you have a well-diversified portfolio across numerous styles rather than trying to pick styles, because it's probably fair to say that you would have been in value 5 years ago just purely based on valuation, which you would have lagged the market if you were trying to time that. In terms of just giving you some more context about diversifying strategy, this is just some example, but the types of managers that you may look at in terms of those different components. So from a beta perspective, we've got the Fidelity Australian Share Fund, which is an active long-only strategy, and that provides you that long-term market exposure. In terms of risk control, we're looking at managers such as Pengana, who have the ability to hold a fair bit of cash in their portfolio, certainly at times where the manager believes that valuations are stretched. And on the alpha side, a small cap exposure. And in this instance, we've got that a Novaport small caps. But it just sort of, I guess, highlights that you're under this sort of methodology where you're really looking to allocate to strategies that, one, have a very specific function within the portfolio, but then also that you are diversified in terms of how these managers will perform in different cycles. So if you look at through the cycle, you should have a more consistent and smooth ride over the course of the investment time horizon. Now, how do you measure what your factor exposures are? And look, there's a variety of ways you can do this, and there's certainly tools out in the market that allow you to measure this. How we do it from our portfolio perspective is, one, obviously from a qualitative perspective, we'll have an understanding of what the various characteristics are of the respective managers, but we are then also looking from a quantitative perspective and looking measuring what those exposures are. We use external system style research where we effectively put in all the stock holdings for all the various investments that we invest in, and it gives us a clear breakdown of what our various risk factor exposures are, be it style, be it market cap, sector, and stock specific risk. And this certainly isn't intended to drive portfolios, but it is good to have some visibility on what your risk exposures are, just so you're not overexposed. And one of the interesting things and examples I typically refer to is in the fixed interest part of the portfolio. If you go back to pre-GFC, I mean, the bond sector is probably the most diverse sector in terms of funds and what they can invest in, and we would probably categorise it as those managers that are, I'd call the dynamite bond managers, that yes, they are bond managers, but they're investing in very high risk type securities, through to your cash type managers and everything in between. So when you look at your portfolio on a bond exposure, just ensure that you've got a really good understanding of what your exposure is, for example, to credit, to government bonds, what is the maturity of the portfolio, what is the duration risk, etc. Because again, it's just more of a matter of best practice and a matter of ensuring that if you do have any material market event, that again, you're not overexposed to a single part of the market at any given point in time. So one of that was probably sort of some of the key points that I wanted to go through today. And the key takeouts I would sort of leave you with is that we're possibly at the tail end of unconventional monetary policy. Monetary policy, quantitative easing has certainly been a drug to many asset classes. It has supported many asset classes. Low bond yields have absolutely supported the things like listed property. We've seen the defensive stocks do well in this environment, but we are possibly seeing a bit of a turning point, and we may be seeing the interest rates notching up globally rather than continuing to notch down. So in terms of those within your own portfolios, just being cognizant of what your exposure is to some of those sectors, and understanding the risks associated with that. In terms of Trump, look, that has been a real impact. It has certainly boosted some of those already positive signals that we've been seeing in the economy. The big thing to think about is execution risk, and that's what we would think is one of the biggest risks to think about. To what extent he'll be able to execute on some of those pro-growth strategies, because the market has certainly factored in a very positive outcome in those things. And if any of those things, if you fall short of any of those measures, then just be prepared that the market may pull back. And in our view, we think the markets have overshot a little bit in terms of that positive sentiment there. Markets have certainly been strong despite Trump elections, Brexit, the rest of it, but valuations certainly are, in our view, at fair to expensive. Valuations tends to be a medium to long-term signal, so it tends to work over a 3, 5, 10-year period. It's not a short-term signal. So within your own processes, if you are looking at valuation as a signal, it is a long-term type signal. Markets can look expensive for some time before you see valuation coming through. But if you think about the recent cycle, we've probably been into 8 years of a bull market. The average length of a bull market is 8 years. Now there's obviously everything below and higher than that, but that's just an interesting point to note. Value has certainly back after a long hiatus, and from a portfolio perspective, just think about what exposures do you have to the different types of styles within your portfolios. And then finally, we think that if we're seeing an environment that is more fundamentally focused rather than central bank policy focused, we think that there'll be a lot of opportunities for active management in this environment. So if you think about, until recently, being long beta and just riding the market has absolutely been a winning strategy, because you've just ridden that wave up. But we think there's going to be more dispersion in markets going forward, and certainly more dispersion in fund manager performance. So again, thinking about that from a portfolio perspective is important. In terms of our capabilities, we run a range of, we've been running model portfolios for over 15 years across direct and unlisted securities, and we also offer those within an SMA type format. And we do work with a range of dealer groups as well in terms of assisting them in the construction of their managed account portfolios. And here are my details and one of my colleagues' details. If you have any questions in relation to the presentation, or you'd like to discuss some of your portfolio construction considerations, and happy for you to reach out. So with that, thank you very much for listening in and your attendance. And I believe we have some questions here that we can answer. Okay, so question one was a question from William. What are your thoughts on how to allocate between active and passive? I think hopefully in sort of that summary comments, we do think that going forward, for quality active management, the market will be more ripe for active management, as we see potentially more dispersion in the market in terms of asset class and sector returns and stock returns. It is all obviously about identifying the quality managers. There are some sectors that historically have been more conducive to passive management. Historically things like Aussie listed property has been a sector that a lot of investors have allocated in a passive perspective. But overall, I'll sort of suggest that thinking about some active exposure, if you don't already have some active exposure in the market going forward, makes sense. Okay, there's another question here. Given no style will consistently outperform, does this mean portfolio should always have some allocation to all styles? Look, we would suggest that that is the case. Trying to time and picking when styles are at inflection points is difficult. As we've seen, growth has been the winning strategy for well over 5 years, despite growth looking expensive. Conversely, value's been cheap for a number of years, and it's only until recent times that it's come to fruition. So trying to sort of time those turning points is difficult. I don't claim to be able to do that consistently is problematic. So we would suggest that having a portfolio where you've got different levers across those styles makes sense, and that over time that will smooth out over time. So that would be our view. Just looking at some other questions here. Okay, so there's a question around currency from Tom. Should we be using currency hedge funds or a combination? So just to give you a sense of what our long-term perspective is. So over the long term, if you look at our total portfolio, so that's looking at all assets, so bonds, equities, property, etc., we're generally roughly around 50-50 hedged. In terms of the global equity exposure, our neutral position is unhedged, and the rationale over the long term for that is that, one, given that a lot of Australian investors have a meaningful exposure to Aussie equities, an unhedged exposure provides far better correlation benefits than a hedged exposure. How we typically allocate, though, within that global equity component is to have managers that can actively hedge their portfolios within the portfolios, and that's how we've typically managed currency within portfolios. Probably another question here, US versus Europe, how would you manage the mix between the two markets? So certainly the US market has been the clear winner in recent years. So if you think about any fund manager that has been long overweight US has certainly outperformed managers that have been underweight the US, that have had more exposure, for example, to Asia or more exposure to Europe. So Europe, look, we would, in terms of, we don't look to tactically allocate between the two, but we would say that things, despite all the doom and gloom around Europe, a lot of the economic indicators are picking up albeit from lower levels, they are picking up. And there are a lot of companies, good European companies that are attractive in terms of, one, their valuations, but also the earnings profile. So from our perspective, we wouldn't discount Europe. And the US market has had a good run, certainly not looking cheap. So it may be opportune to think about having some exposure to Europe within the portfolios. And that's probably the key questions that we've got at the moment. Look, if there are any further questions, as I said, we've got my contact details there. More than happy for you to reach out to me directly if you want to have a chat.
Okay, great. Thanks, Lukasz, for presenting the webinar today, and thank you for everyone who attended. We hope you found it insightful and hope that you'll join us at our next webinar.